with all that market action, we shift focus to approaching investing in uncertain times. Volatility in global markets has led to investment markets and economies becoming more unpredictable, leaving investors looking for secure ways to safeguard their capital. Earlier, Debra Slabber, Portfolio Specialist Director at Morningstar, joined us with a greater insight into investing in uncertain times.
Yeah, 2025 surely kicked off on a very interesting note. What we are witnessing at the moment is just so much heightened uncertainty and almost a complete repricing of risk.
Yeah.
So a sell-off across equity markets, we're witnessing a weaker dollar, and you have a market now that came into the year quite optimistic about returns, and that's turned very quickly. Now the market is pricing in possibly lower growth, higher inflation because of the tariffs, consumer to be possibly under pressure, and then of course central banks to probably step in and cut rates much sooner than the market initially anticipated. Yeah. So I do think there is quite a lot going on, and the situation is very fluid, so it changes on a daily basis.
And actually, I mean, it's quite interesting. You talk about this repricing of risk. And I just want to know, in terms of the market narrative right now, is it valid, or would you say that it's more centered on headlines?
I think it's a little bit of both. I mean, I don't think we can ignore the fact that tariffs will have an impact on the global economy. It will have an impact on growth. It will possibly have an impact, and it's already have an impact on investor sentiment and how companies are thinking about allocating capital. And I think the big risk that we're sitting with here is the earnings risk. So when we move into an earnings reporting cycle again, it will be a bit more evident in terms of what those companies are thinking. And I guess the range of outcomes is just so wide because it's going to differ so much between different companies, different sectors, different industries. So I don't think we can ignore it, but I do think there's a fair amount of sensationalism also going on. For example, the 60% tariff that SA is posing on the US, that's factually not really correct. It's actually much lower, but the headlines suggest quite a lot of panic.
Yeah, so you actually need to sift through those headlines to actually check your facts. And it's quite interesting that you talk about the fact that the threat is really on company earnings. I mean, just from the US, we've had JP Morgan CEO Jamie Dimon earlier on in the week warning about higher prices and recession risk. We also had today Delta Airlines cutting its 2025 earnings guidance. They pulled back from that. We also did have Walmart actually dumping its operating income outlook for the current quarter. So you can already see the early signs of a panic there. But just looking at, the US markets, because it was quite interesting ahead of, the 2nd of April, the South African market had actually been doing quite well, going to record highs, and the US markets were already tanking. I'm just wondering, how are you looking at the US equity space versus emerging market equities?
No, that's a great question, because we came into this sell-off and our portfolio is actually being underweight US equities, and for no other reason than we just thought that a big part of that market is actually very frothy from a valuation perspective. So we were in particular underweight US tech, and we were overweight other parts of the market, in particular areas like Europe and emerging markets as well. So South Africa on a year-to-date basis, excluding the last 2 weeks or so, has actually done really well. We've seen resources coming back, almost back to life, which lagged quite a lot last year. But of course, I think we need to take into account that we are a very open, vulnerable economy. So we've witnessed very large price movements in the last couple of weeks, and that is tied to both what's going on from a global perspective and the uncertainty around risk assets. And then secondly, also we've got our own political issues in South Africa, and that's also been driving some of the weakness. So you've seen the rand blowing out to quite low levels. We've seen bond yields increasing. So I think you need to take a bit of a balanced approach here. From a portfolio perspective, we still like emerging markets. We do like South African equities. We do like South African bonds. It's an asset class that you can't really ignore at these yields with inflation where it is at the moment. But I think it just all boils down to you need to be diversified, and it's probably the most underrated investment tool. If I think about last year, we had to apologize for being diversified because you had a very narrow grouping of stocks driving market returns. And you had to say, I'm sorry, I'm a diversified investor. And right now, we're seeing diversification is working because the sell-off is not equal across regions and across asset classes.
It's actually quite interesting because when we talk about diversification, a lot of the times people will be looking at diversification within equities when actually you should be broadening out to other asset classes as well. In terms of that, is there any ideal kind of composition of how much weighting each should be?
Actually, that's an interesting question. I would say there is not an ideal for that's going to fit every single person. It very much depends on the amount of money you have to invest, your time horizon, your tolerance for risk, your liquidity needs. So it very much depend on client by client. So at the end of the day, you need to make sure that you invested in the right mandate that suits your particular needs. But diversification is never a bad idea, and we're seeing it especially in times like these.
So would you say that this is also a narrative that investors need to be proactive rather than reactive?
I would say no to that. I think this is an environment that calls to be very patient and measured. I think at minimum, what we are trying to do is just to rebalance portfolios where there's been severe drift. And the second thing, what you're trying to do is you're trying to not rush out to just buy assets for the sake of it. Take your time. Try and assess and understand what the long-term impact will be. Make sure that you build a proper conviction around an investment opportunity as they emerge. And I think the most important thing throughout of all of this is if you have a robust investment process, like what we try and build at Morningstar for the last 40 years, you try and build a process that will work across different cycles. And you also have that ability to change your mind should the facts change. So you have to be adaptable and you have to be humble, because the markets do humble us, like what we've seen in the last 2 weeks. And we're going to see plenty more of that in the future. Volatility is very normal when it comes to investing in the market.
So say you are not an investor that has been measured for the long term before this turmoil. What then is the first thing does an investor need to do when a meltdown ensues in the market?
Close your computer, switch off your TV, and don't look at the headlines. Don't panic, because this is absolutely normal. If you find yourself a good investment partner, you know what your tolerance for risk is, you know how much what your savings goal is and your retirement goal, and you invest according to that, and you do that over and over for your lifetime, you're going to be 100% fine. It sounds extremely boring, but unfortunately, investing is not supposed to be that exciting.
Only the returns are going to be that exciting, and usually the boring companies and boring portfolios usually have exciting returns. Thank you so much for your time and just for really that advice and insight, Debra. Really appreciate it. That was Morningstar's Portfolio Specialist Director, Debra Slabber.